Hey everybody, my name is Grant White, and in today's session, we're tackling a pivotal issue that impacts every Canadian business owner and incorporated professional out there. The 2024 federal budget has introduced significant changes to the capital gains inclusion rate, changes that could have substantial implications for your financial landscape. Now today, we're not just going to skim over the basics. We're going to dive deep into what these changes entail and what they mean for you. The capital gains inclusion rate has been a cornerstone of Canadian tax planning, influencing decisions from asset sales to long-term financial strategies. And with the new amendments that have already taken effect, understanding these changes is more crucial than ever. Whether you're planning for retirement, considering selling your business assets, or just looking to optimize your tax strategy, today's discussion is designed to equip you with the knowledge that you need to navigate these turbulent waters. We'll explore how the adjusted rates could affect your financial decisions and outline strategies to help mitigate those impacts. These updates are not just numbers in a policy document. They're pivotal factors that could redefine your approach to wealth management and tax planning. Let's get started and break down what this means for you and your business. Let's dive into one of the most substantial changes in this year's federal budget, the adjustment of the capital gains inclusion rate. Now, traditionally, this rate has been set at 50%, which meant that only half of the capital gains realized in any given year would be subject to income tax. Now, this has long been a significant aspect of tax planning for both individual investors and corporate entities. However, moving forward, there's a pivotal shift that will impact many. For individual taxpayers, the game changes once your gains exceed $250,000 in a single year. Now, beyond that threshold, the inclusion rate jumps up to 2/3 or 66.67%. This means that 2/3 of any capital gains will now be taxable. It's a move designed to increase tax revenues, but one that also necessitates a strategic rethink for high net worth individuals and those with substantial investments. Now, corporations and trusts, on the other hand, will not benefit from any threshold. So from June 25th and onwards from this year, all capital gains that you realize will be subject to 66.67% inclusion rate. This represents a uniform tightening of the tax regime for these entities, potentially increasing their tax liabilities significantly when they realize gains for their investments. Now, this change underscores a clear message from the government, a push towards greater tax equity, but it also represents new challenges and planning opportunities for investors. Adjusting to this new tax environment will be crucial, as the strategies that worked in the past may no longer be as effective under this new tax regime. The recent adjustment in the capital gains inclusion rate isn't just a minor tweak. It's a significant change that could fundamentally alter your financial planning landscape. Now, this is particularly true for incorporated professionals, of course, and business owners who need to reassess their strategies for wealth creation, investment handling, and retirement planning. Firstly, for individuals and corporations alike, the higher inclusion rate means a higher tax liability on investments that appreciate in value. Now, this change could shift the attractiveness of certain types of investments compared to others. For example, investments that are more capital gain intensive might become less favorable compared to those yielding higher income or dividends perhaps, which might be taxed differently. Incorporated professionals in particular need to be vigilant. Many rely on their corporations not just for operational income, but also as a critical component of their retirement planning. Now, with these new rates, the strategy of retaining earnings within the corporation to capitalize on potentially lower and personal tax rates upon withdrawal in retirement might need reevaluation. Let's not overlook estate planning implications. Higher capital gains taxes can significantly affect the inheritance you plan to leave behind. It may be prudent to consider strategies that minimize your taxable estate, such as gifting assets earlier or utilizing trusts and insurance products designed to shield assets from heavy taxation. Overall, the key will be proactive engagement with your financial planner to navigate these changes. Whether adjusting your portfolio, rethinking your corporate structure, or planning for future liquidity events, personalized advice will be more valuable than ever to ensure that your financial goals are met in an efficient and tax-effective manner. Navigating these new capital gains inclusion rates requires a strategic approach tailored to your unique financial situation. Let's get into how you can effectively respond to these changes to safeguard and potentially enhance your financial position. Regarding your capital dividend account, or the CDA, the increased inclusion rate could mean less money flowing into this account when realizing capital gains. Now, since the CDA allows you to pay tax-free dividends to Canadian shareholders like yourself, the reduced credit to this account could affect your ability to distribute wealth efficiently. Recalculating potential tax burdens is also paramount. With the new inclusion rate, your future tax liabilities on investments could be significantly higher. Now, this recalibration isn't just about crunching numbers. It's about rethinking your asset allocation, possibly increasing the proportion of tax-efficient investments like preferred stocks or bonds, or exploring other tax deferral or reduction strategies such as flow-through shares or specialized investment funds. funds. For business owners and incorporated professionals, restructuring your business assets and considering how and when profits are withdrawn from your company may also provide tax efficiencies. This might include adjusting your compensation strategy between salary and dividends based on new tax realities, or reassessing how you reinvest profits back into your business. Lastly, it's advisable to consult with a tax professional or financial advisor or financial planner to ensure that these strategies are aligned with both your current tax legislation and your personal or corporate financial goals. Making informed decisions based on professional advice will help to mitigate the impacts of these tax changes and ensure that your financial planning remains robust and responsive. While the changes to the capital gains inclusion rate present new challenges, they also open up opportunities to explore innovative financial strategies. So if you're concerned about how these tax adjustments might affect your finances, don't worry. You're not alone, one, and we're here to guide you through these complex changes. So in our next video, we're going to dive deeper into effective solutions to help you to lower your tax burden under the new rules. Now, one powerful tool we'll be exploring is the individual pension plan. An IPP offers a tax-efficient retirement solution for business owners and incorporated professionals, allowing for larger tax-deductible contributions than what a traditional RRSP would allow. We're going to break down how an IPP can be a game changer in your retirement planning, providing not only the significant tax relief that also a more robust pension provides, but you'll also learn how this strategy fits into a broader financial plan that considers the increased capital gains rates and other recent tax changes. Join us next time to ensure your financial planning is as efficient and effective as possible. Subscribe and hit the notification button so you don't miss out on any of these crucial strategies for lowering your tax rate and securing your financial future.